what we're here for today is a kind of a follow-up on the workshop we had yesterday where we did the top 10 basic indicators. And today we're going to get a little bit crazy. We're going to talk about the top 10 advanced indicators. And I think some of these are so advanced, that I don't even know how these guys, figured out how to develop some of these things. And it was really kind of an interesting learning process for me. Because, for those of you, I've gotten to talk to a lot of people, and they ask me, what indicators do I use? And I've mentioned that I enjoy the slow stochastics. I've been using it for years. And I use a 14, 3, and 3, the value on that, because I like to slow it down, because I like more reliable signals. When I was young, I used to be a cowboy, and I used to like to be in and out all the time, and it was a lot of fun. But at the end of the year, I realized I wasn't making any money. So something had to change, Either I had to accept the fact that I was in it for excitement, or I had to be in trading because I wanted profits, And it becomes a point in time when you just have to realize that there's something I have to change because I want to be a profitable trader. And that's when I started using a more consistent approach, taking a step back from the market, because I was like anybody else. The first thing you do is you call up a 5-minute chart, you put about a dozen indicators on there, and you stare for 3 or 4 days. Like, what am I doing? What do I do here? I'm going to wait for all of them to line up. And 3 years later, you realize that none of them, they don't always line up, So I got to do something different. So we'll try it on an hourly chart, and you do that, and they still don't line up, okay? And so what I like to do is whenever I talk about indicators is really mention that they are tools, okay? They are a tool designed to help you time your entry. They will not tell you where the market is going. Nothing will tell, in spite of what you see on TV, nobody knows where the markets are going, okay? And people always ask me that, and I like to tell them that the traders that I've met, the traders who I learned from, told me that the best traders in the world react to the market. They don't try to predict the market. Okay? Predicting is great on TV, it's great on radio, and it's great in print. But you ever notice that they're really not usually the traders that are on TV predicting the markets? The traders are the guys on the phones with all the screens in front of them, reacting to what the market is doing and finding a good point to jump in with a strong trending move and just riding it for as long as they can. Okay? Now, so before we get into the indicators, I like to talk about when I use an indicator in my approach to trading. Okay? And it's really a multi-step process. But I know that I'm going to have to take a step back because this is kind of an important slide for me. And I always mention it, and it's like, okay, here he is. He's going to start talking about, this is speculating. This is for pure profits. And I know I've had a lot of people talk to me about using retirement funds, and I really hate, for people to use any kind of funds other than money that they're willing to lose, okay? Because, when we come into FX trading, we're speculating, and we're, in spite of what we read, people are not looking really for 25, percent or 20%. Maybe if you're in the stock market, they tell you if you earn 8%, you're doing well. You buy bonds, and bonds, they're doing 4% now, or whatever the situation. I mean, we're speculating. We're looking for triple-digit returns. Let's not kid each other here. But with risk comes reward. There's no way around that. It's the yin and yang of light. You can't have light without the dark. Okay? So we're using funds that we're okay with if we lose. We don't have to like losing. Nobody likes losing, but we have to be okay with losing. Okay? So we only want to use funds that we're willing to use because this is pure speculation. Okay? We're looking for the big gains in the market. And that, with the big gains, comes the potential for big losses. And believe me, how many live clients do we hear at FXCM? Okay, what's the one guarantee in trading? Anybody know? You're going to have a losing trade. Okay, that is the only guarantee in trading. You will hear all kinds of guarantees, but there's only one that is the truth. And if you trade, you will have losing trades. But how you handle those losing trades has as much to do with your long-term success or failure in the markets as perhaps any other factor. Okay, we don't have to like losing, but we have to be okay with it. See, I already said this, so let's move on past that one. Now, there's two situations I like to look for in a market, and we talked about this yesterday, but I see a lot of new faces there. And that is how to identify a trading opportunity, okay? Because before we use that tool to help us identify our entry, we have to first identify a trading opportunity in order to use that tool, okay? And when we're looking for a buying opportunity, what we're looking for is a strong trending market to the upside and those pullbacks down to support, okay? At every letter here, wait a minute, I bought this on the way, so it's time to use it. At every point here where it says support, this is, to me, a buying opportunity, okay? We have a strong uptrending market. It is pulled back off of a high down to support level. I'm looking for that reversal back to the upside. Okay? Now, I'll admit, after we see it on here, when you go back on this chart, it's very easy to draw these lines and where support is and say, see, if we would have bought there, that would have been a great buying opportunity, potentially a profitable trade. Okay? But how you do that live is a little bit different. But that's why you're all here, right? Because that's what technical indicators can do for us. They can identify that point when the sellers are losing control and the buyers are coming back into the market and taking control of it, hopefully to push it up to new highs. And we want to be one of those guys. Okay? Now, the first thing I do, and this is not one of the 10, so you're not getting cheated if you were in the basic indicators yesterday, is I put a 200-day simple moving average on all of my charts. Okay? And what this is just a quick reference point for me. It kind of gives me an idea of the direction and strength of the trend. Because what I like to see is the moving average moving up, the market moving up, and I like to see the separation. Otherwise, this is almost a parallel line. It's like a railroad tracks moving up. Okay? And that's the perfect situation for me to look for in a buying opportunity. Why? Because there are two things. These trending moves can be 1,000 pips. The moves against the trend can be about 500 pips. That's why the market is moving up, because the trending moves are about twice as long as the moves against the trend. Okay? So if I'm trading with the trend, I automatically increase my chance of success because, as I've talked with a lot of people before, and they understand this because they agree with me, there's more room for error when you're trading with the trend and the momentum of the market. You don't have to be exact in your entries and your exits, because if you get in a little bit too early or you get in a little bit too late, it's that trend or the momentum of the market that can save you. If you're trading against the trend, you pretty much have to be exact in your entry and exit to be consistently profitable. You know what? We're human. We make mistakes. Doesn't matter how long you've been around. There's really no such thing as being exact on every trade. And if you expect that of yourself, that might be a little bit more than anybody should put on themselves. We want to make it a little bit easier on us. Okay? So we want to trade with the trend, and we want to trade in the direction of the trend. So what I do is I'll look for the strongest trending markets. I'll look for about 20 currency pairs on the daily chart with 1 year of trading, and just identify the strongest trending moves I can find. Is it cherry picking? You better believe it. Is it okay? Yeah, it's okay. You should be doing it. So this is the Aussie Swiss, which is currently my favorite uptrend. On the flip side, a sell is a rally up to resistance when the market is in a strong uptrend. And I was telling people, we had talked about some of these yesterday, where the markets have actually gone through these lows in the last few days. You know, I missed it. I was here, but that's okay. There's more trades coming up. Okay, but every time this market moves up to resistance level and starts to roll over to the downside, that's when we want to get in on a selling opportunity. Okay, and that's where the use of a technical indicator can be of great value to the trader. But we want to be trend traders. We want to trade in the direction of the trend, and then we only want to use that indicator to help us time my entry, to help us time our entry. As soon as I'm in the market, I don't need the indicator anymore. I don't get out using indicators. I only get in using indicators. Because I'm not trading slow stochastics. It doesn't matter. Well, I got in when slow stochastics was 22 and I got out when it was 80. How much money do I make? It doesn't matter. You know, we're trading the FX markets. We're trading these numbers here. Okay? So really, as soon as I get in, I don't need the indicator anymore because I'm going to let the market itself, the price itself, determine my exit on the trade. And we got the same thing on the downside. I put the 200-day simple moving average on that. Just to give me a quick reference point, this is really the most popular indicator in use today in the financial markets. That's my opinion, of course. I didn't make any phone calls before I came here. But if you look at just about any publication, if they have a stock market, they'll have a 200-day simple moving average on there. And it really started with these guys who are doing mutual funds, and they're going through hundreds of stocks on a day and trying to analyze them. You know, they need some sort of tools to help to make the process a little bit quicker. So they put the moving average up there. And when they see a situation like this, that goes into the good pile. Okay, we'll come back and look at that one again. So the market does react to this moving average. Even the FX markets do. Here's the first one I like. This is actually one of my favorites. It's called the Donchian channels. On a lot of charting packages, it's called the price channels. Okay? And this was developed more than 50 years ago by the father of commodity timing. I mean, this guy was famous. He wrote a newsletter for decades. And he's a New Yorker, but in spite of that, we'll talk about him. He's a good guy. And basically all he's doing is he's noting the high of the previous certain amount of days and the low of a previous certain amount of days, and he's just putting it right on the chart itself. Okay? When I talk about an uptrend as a series of higher highs and higher lows, I mean, if you're just looking at a chart, you can say, I'm not sure really what he means by that. Or a downtrend is a series of lower highs and lower lows. Basically, what do I mean by that? This is where an indicator like the Donchian channels, it comes into, it's really of great value and can really help a lot. And the best way we can look at that is just to look at a trend. Now, I've got the channels here. This is a 20. Okay, so what this is telling me is a 20-day high or a 20-day low. Okay, we can see the market here. This is the line that represents the low from the previous 20 days. Okay, so what a lot of traders will do on this, and as a matter of fact, in the next hour, and I talk about high probability breakout trading for anybody that's familiar with the turtle traders from Chicago, this is what they did. This is how they made hundreds of millions of dollars. So basically what people would do is that the market's in a strong uptrend, they're looking for buys. They have their directional bias. They already know they're looking for a buy because the market's in a strong uptrend. They would just buy as the market broke out to a new 20-day high. So you buy it right here, and this is where they put their trailing stop, and they just follow the stop all the way up until it comes out here. And that's when they get out of the market. Okay? Yes, sir? It is, and I want to give you a website right now, and I'm sorry I don't have a slide that I put it on here, but it's www.fxcodebase. That's FXCODEBASE. It's a nice little website that has about 4 or 5 dozen indicators, and it's got the code that you can move over to your MarketScope charting package quite easily, and it has instructions on there how to do it. So when you call up your technical indicators on the MarketScope charts, there's about maybe 25 to 30 on there. You can really get crazy and put about another 40 to 50 on there if you want. If this is one of them. Now I warn you, I would prefer to put the Donchian channels on there. There's also one on there called price channels, but I prefer the Donchian channels. There is a little bit difference in what they did, and this one is just more accurate to what I'm looking for, or to what was used by Richard Donchian. So you can get it on there. And there's just a code on there, and it gives you instructions. It's very easy. It takes about 30 seconds to put an indicator, a new indicator on the MarketScope charting packages. Yes, sir? Not that I'm aware of. They went with Richard Donchian. They were just students of his. It was Richard Dennis who was a student of this. Yeah. No, that's fine. That's fine. Thank you. But they were using 20-day breakouts. They were using 40-day breakouts, 55-day breakouts. They would only win about one-third of their trades, but when they caught a strong trending move, this line wouldn't touch for maybe a year, and they would make their year on just a few trades. Okay, you have to be very patient and very disciplined to trade like that. But I'll be talking more about them. I don't want to spill the beans here. I'll be talking about more about them in the breakout trading workshop, which follows this one. But one of the main things it will help you do is you can see the series of higher highs and higher lows, because every time it touches the band, okay, I mean, you can see, and it's very easy to see the stair steps moving up, just to make it easier, number one, to identify the trend. But number two, many successful breakout traders use nothing more than Donchian channels. Whether they use 20 or not is a matter of personal preference, but that's basically all they do for trading, and how to get in and how to get out. And a lot of people have asked me, how I get out of the market. Usually I trail my stop. You can see that this is an excellent tool to help you do that. Yes? Yeah. Well, which two? Here? Yeah, well, this one would be a losing trade right here. That'd be a losing trade right there. Yeah, that might be break even. And this one you're in, we're still in this one. As a matter of fact, this mark is above 1 now, I think. I wish I could answer that one. I would truly share it with you, especially you. I would share it with you. But, it's called blind faith, and that's what trend trading is. But you know what? If you find a strong trending move, you increase your chance of success of it continuing to move in the direction of the trend. Trends in the FX markets can last for years. Okay, it takes a long time for a government to change economic policy, and I think that's something that everybody knows is true. They can go on for years and talk about stuff for years, before something actually changes, before they make some sort of a change. A company's a different situation. You can have, an earnings release overnight can change everybody's outlook, can change a trend on an individual stock. But the FX markets are known for their long, strong, trending moves, which is why many people who traded the stock market moved over to FX to take advantage of those long, trending moves. This is an edge to trading FX. This is something that we want to take advantage of. If we don't take advantage of it, if we trade against the direction of the trend, then we're giving that advantage to the trader on the other side of our trade. Why would we want to do that? Yeah, unless that was a way for you to donate money, I don't know. Yes, sir. Well, I'm a big believer. The fundamentals it's a very strange thing to try to figure out. I read it all and I get confused, And so my interpretation is that the direction of the trend is what everybody thinks about the fundamentals of the market. So if I'm trading with the strongest trending markets, I'm already incorporating the fundamentals into my trading. Now all I have to do is incorporate the technical analysis to further time my entry in that direction, and I think that's the perfect blend of both fundamentals and technicals. And as far as news releases, I avoid them. They're entertainment only. Yes, over here. Yeah, we're going to get into that. I've got a secret for you. I think actually it's in the next one, but I will tell you. What I would do is when it touches the bottom channel, I might pop down to a 4-hour chart and look for my buy entry then. Okay, by incorporating multiple time frame analysis in my approach. That's what I would do. Because I wouldn't want to give up that much. I'd be looking for when the market pulls down here, I'm on the 4-hour chart looking for my entry back to the upside. That's what I would do, but that's not what the breakout traders did. That was it? Did I miss any? Yes, sir? A lot of times they're going to do the same thing. Bollinger Bands basically are a 20-period moving average, and this is basically a 20-day high and low, which kind of, becomes related. The Bollinger Bands include the volatility at the same time, though. That's the additional filter. So you're going to find a lot of times during volatile times that the market may not touch the bands. This will. It'll be interesting. I've done it. I mean, sometimes it can give similar. The advantage here is I know beforehand what tomorrow's 20-day low is going to be when I have no idea what that value of the lower Bollinger Band is going to be. To me, that's the advantage of using the price channels, or the Donchian channels, excuse me. We had a question up here? Yeah. Yeah, and you know what, thanks for bringing that up, because I had some people ask yesterday, and they talked about where I place my stop or where I would place my entries, okay? And I consider a breakout 1 pip above the high. Not 10, not 15. I don't need wiggle room. 1 pip, it's a breakout. So I would place my buy 1 pip above after clicking the A, which gives me the buy side price of the markets. Everybody understands that there's a spread in the currency pairs? The B is the bid side, the A is the ask or the buy side. So if I'm looking to get in on a buy stop, I want to click that A, and I want to see where that channel is at that point in time, and I would place my buy 1 pip above. A breakout's a breakout in my mind. Yes, sir? I don't, but there's nothing wrong with using, this is a classic, morning star right here. There's nothing wrong with using candlestick analysis when this market would hit the bottom of the price channel, okay? But you have to realize candlesticks analysis is similar to the technical indicators. It's the last thing you want to look at in the process of identifying a trade, not the first thing, okay? But candlesticks, really, you can look for morning stars and evening stars, and you can see them all over a chart, and they're of no value at all. However, if you see a morning star form at support in a strong uptrend, now it's a little bit more valuable. And basically, that just helps you time your entry. They will not tell you where the market's going. That's just my opinion. Okay? Yes, sir. Well, no, the price channel I know. Because I know that, say, this low here, this is it. And I know that's going to be the low for 20 days. Okay? All I have to do is count back 20 candles, or 19, to find out tomorrow's low and high value. Okay? I can just look at the high, the previous 19 candles, and the low, and that's going to be tomorrow's channel for the high and the low. On Bollinger, No, no, no. Absolutely. That's going to be the price channel high and low. The market could trade up through the high and the low all on the same day, for all I know. But I know what the price channel high and low is going to be tomorrow. I don't know what the Bollinger Band high and low value is going to be. I have no idea what the low of the market is going to be tomorrow. I do know what that price channel value is going to be for tomorrow, though. But the market could trade through that. And then the next day, I would have a new 20-day low for price channel. On this day here, you see this day here, I know that this low is going to be the low for the next 20 days unless it trades through that low price channel. Yeah, then that would be a new low for the next 20 days unless it trades through that on the next, So I only know where the previous 20-day low and high is, not, it absolutely could set a new low. I don't know where the market's going to trade. Yeah, but I do know what the 20-day low is going to be tomorrow, today. If the market trades through it, then that's something different totally. I don't know what that low is going to be 2 days from now, because I don't know what tomorrow's low is going to be. You see this low right here? This is the 20-day low. Okay? As long as it doesn't trade through this low today, I know that's going to be tomorrow's 20-day low. And if it doesn't trade through it tomorrow, I know it's going to be the next day 20-day low. Until I go to 21 days after that where there's going to be a new low. And that's why it's moving up. Yes, ma'am. Well, it all depends on what you're doing. If you're buying the pullbacks, potentially there are quite a few of them. If you're buying the breakouts, this one is going to be a winning trade. This one will be a losing trade. This one's going to be a break even, and you're still in a winning trade here. But it all depends on how you use this approach. This is not really so much an approach to trading, but just a reference point to determine highs and lows. Now, the turtle traders who have made hundreds of millions of dollars in the market and are still among the top traders in the world would typically buy the breakouts. They would buy the breakout above the high. Their win percentage was about 33%. But a couple of times a year, they would catch a trade that just wouldn't stop, and that would be where most of the profits would be from. It takes a lot of patience and discipline to trade like that. Okay? And we have the same thing on the downside, the Euro-Aussie, which is my favorite trend, and you can see a little bit better situation as far as buying breakouts. If you sold it here, you didn't get out until here, and if you sold it again, you'd get out here. You sold it again, you're still in this thing from about 155. And what are we now, about 145? That's not too bad. So, which brings me back to the key. The key to using all of these things is find the strongest trending market you can find, because everything else can fall into place if you catch the right currency pair to begin with. Okay? Let's move to the next one. We have lots. A rune. In 1995, it means dawn's early light. And I admit I've seen this one for years. I mean, this is almost on every charting package, and I never really used it. But I started playing around with it, and guess what? I think I kind of like it. So let's take a look at it. Basically, it's kind of telling us there's two lines in there, an up line and a down line. Okay? And as soon as you get it right, it was a little confusing in the beginning to try to figure out what they're saying. But of course, on these charts, we're going to have the advantage of circles. Okay? This is the down line. What we're looking for is for the down line. Remember, the market's in an uptrend. We're looking to buy the pullback down to support. Okay? And that's the down line when the market pulls down. When the market pulls down to hit the extreme level, this hits 100. Okay? At that point, then we want to look for potential buying opportunity. Okay? And you can see that these caught probably the three biggest pullbacks on this daily chart. Okay, again, at this time, we can either use another indicator to help us time our entry. We can move down to a 4-hour chart to time your entry. Or some people will just use it right here and go ahead. Or you can use candlestick analysis to time your entry. But you can see how it really kind of picks the pullbacks down to a support level nicely on this chart. So I started looking at it on different charts. Now, on the flip side, the market's in a downtrend. We only want to look to sell rallies up to resistance. So we want to look for the upline to hit the extreme. And we can see, again, it coincided nicely. As a matter of fact, it hit it right on that candle. And we have another one where it hit on this candle. Just missed it here. But that's okay. You can't catch them all. We may have been in the Aussie Swiss on the buy side on that particular situation. Okay, this is available. It's already on the market scope charting package, the Arun. Okay, but yes. I hate to say that because I think they're all lagging. I hate to say that because as soon as it does, somebody's going to say, well, I got in when it hit the extreme and then it went another 4 days or whatever the situation. All moving averages really have some sort of levels of moving averages in them. They're basically fancy moving averages, which means they're all lagging indicators. They tell you where the market's coming from. They don't tell you where the market's going, or they don't necessarily tell you where the market's at right now. But they will give you an idea of when the markets may have hit extremes or momentum is starting to change. Okay? And that information is only valuable when you use it in its proper context. And that is, we've got a strong trending downtrend. We see a rally up to resistance. Now we got to look for a selling opportunity. And then they will catch it as it's happening. But I really would hate to to kind of term it that way. Yeah, is the 25 here? No, it's not my standard. That was just a default setting. Okay, I mean, I'll play around with all numbers. Basically, my rule of thumb is I very rarely use smaller numbers to speed it up. I typically will slow it down just to make sure that I get some reliable signals. But like I said, I just start with the strongest trending markets I can find. And the indicators offer more value. Really most of the battle is picking the right currency pair to begin with. Okay, and then just all the tools become valuable at that point in time. It's just really, what you see clearer. If one makes sense to you and the other one doesn't, well then use the one that makes sense to you because they're really all telling us the same thing at the same time, changing momentum. The McGinley dynamic. This is interesting because when I started with FXM about 5 years ago, we had this indicator on the market scope charts, and I had somebody call me and say, do you know what the McGinley dynamic is? I go, no, share it with me. And he goes, no, you don't understand. I'm asking you. It's one of the indicators on your charting package. And I go, you're kidding. I had no idea. So, I love to research. I got on the internet. I put in McGinley dynamic, and guess what? Nothing found. I go, uh-oh, I'm in trouble. So I put in McGinley, and there's all kinds of McGinleys, but okay, McGinley trading, nothing found. I said, I have no idea what this is, Well, now there's a little bit more on it. Obviously, it's gotten on more charting packages, and basically what it is just a moving average with an additional filter that, for people who use moving averages as support and resistance, the markets can blow right through some moving averages at times. He just puts an additional filter in there to kind of adjust with the market itself. Okay, similar to what Bollinger Bands, he puts a volatility filter in. The McGinley dynamic does the same thing with the moving average. And I was pretty, skeptical on this. I thought, well, this thing has been on here. I've looked at it. It doesn't mean a thing. So I went ahead and I just threw I think a 20-period McGinley, and I thought, holy cow. Somebody's using the McGinley dynamic, I'm thinking, because that's offering some pretty darn good support in an uptrend. Every time the market touched it, it seemed to find some support and reverse back to the upside. Now, before I go trading this, I'd want to check over a few years. One of the advantages of using a charting package, you can go back years and see if this thing has any value. But initially I thought, okay, well, I'm going to put this one aside. I may have to look into this one again. But obviously the situation immediately that I'm looking for is that it's the same thing. We're in a strong uptrending move. The McGinley dynamic is above the 200-day simple moving average. And when the market comes down, that looks like it offers pretty good support and reverses back up to the upside. Okay? I would not recommend that you blindly do that automatically. But I'm going to be looking into it. Yes, sir? Yeah, this was the default number 20. And the reason that a lot of, on the daily chart, there's about 20 trading days in a month. That's why typically a lot of default settings are 20. Because they really are meant for daily charts. Okay? All technical analysis and indicators work better on daily charts than any other time frame. And that's where you'll find most of your big professional traders, and so it becomes more of a self-fulfilling prophecy at the same time. It just adds additional value to using the daily chart. So I thought, okay, it looks good on the Aussie Swiss, but it's probably just, I said, holy cow, it worked on the Euro Aussie too. So I thought, well, I'm going to throw this on. Yeah, it looks pretty good. Yeah. The point he's trying to make is, How do we know that this is a buy? Because we can't see what's going on before this. Okay, and it's a valid point. And all I can tell you that the trend was up at that time. But we do know that the trend is up at this point. We can't see this on this chart alone. Okay, so let's just we can just talk about these and forget this one. I'm willing to throw that one aside. Just because your point is valid. If I had 2 years of trading on here, you'd see something differently. But I do only have the 1 year on here. But let's go down to the Euro Aussie. I also know that this is a 13-year low right here. Okay, so these markets have been trending for over a year now. Well, this is 1 year. This is confirmation right here. At this point in time, we had been looking for selling opportunities at this point in time for a couple of months already on this particular pair. Okay. The Euro Swiss, I would go, or the Aussie Swiss, I would go back and look at it, and see. But we can only make a decision at, today. And that's why I like to use 1 year of trading, and I look for the strongest trending moves. If you look at the Euro CAD, it only moved below the 200-day simple moving average sometime in January, early January. And that's when we started looking for selling opportunities on the Euro CAD. Because I'm looking for the breakouts. I'm looking for breakouts above new highs and new lows. Okay. So at this point in time, even though this was below here, this may have represented a new year high because it may have broken out of a range. I'm assuming that's what happened, but I don't remember, to be honest with you right now. So, but yeah, it's a valid point. Sure. But at the time, we look for the strongest trending markets today, obviously, is what we're looking for. And I go back a year. Yes, let me get you in. Now, there's nothing here that tells me I need to go short. Okay, nothing at all. Because that would be trying to pick a top. And I think I picked one top in my 20 years of trading. And I didn't realize until a week later. I know. I started doing that. I was telling a story where I learned how to trade. At a bank, I had guys who've been in the market for 30, 40 years. I did it once, and boy, the browbeating I got, I still remember. I would never do that again. I would never do that again. And it really doesn't work anyway on a long-term basis. Yes, Greg? Well, no, you wouldn't be wrong. And that's where the price channels would come in and help you because it gives you the point for your trailing stop. It's a good question. When people get into a trade, they always ask us, when do I get out? And when I get into a trade, I will trail my stop with the market because I'm trading with the trend, right? I'm looking for those 1,000-pip moves. But it is a very difficult thing to teach. Well, no, you don't understand. I get out of my trades on a stop. Okay? I don't set a limit. Because every time I've set a limit, I look at the market the next day, and it's above my limit price. Years ago, I decided the more I missed with a trade, the less I made. But I got to tell you, that's the hard part about trading. That is what makes it hard, is staying in a winning trade and having the discipline when it moves 50 pips against you, not to say it's reversed. So I'm getting out. And what happens? It goes down another 5, reverses, and it shoots back up, laughing at you all the way up as it makes new highs. Okay, I just trail my stop, and I challenge the market to reverse and stop me out. And it does. It does. But that's a very, very difficult thing to teach. So that's why we teach people just to use the 1 to 2 risk-reward ratio. You set a limit at twice your risk. Because the idea is to make more when you're right than you lose when you're wrong. And that's one way that we can quantify it. Okay, but that's not the way that I trade. Okay. Yes, sir. Well, it all depends. On a euro pound, it could be 50 pips. On the pound yen, it could be 250 pips. Because I'm looking at the highs and lows. As it moves up, I'd move my stop here. As it moves up to make a new high, I'd move my stop up to here. As it moves up to a new high here, I'll move my stop up to here. And hopefully it just keeps making higher highs and higher lows, and my stop just keeps... But it doesn't always do that. Eventually it'll come down and stop me out. Okay. Yes, sir. I got you. I'm sorry. Sure. That's fine. Mm-hmm. Let me take one more, though. Well, it takes a few months. If this market were to move down through this low, that's not going to be the strongest downtrend I can find. That moves into the gray area where I don't trade it at all. Okay? When the market changes trend, it doesn't mean I'm automatically looking for selling opportunity because I'm looking for the strongest downtrends, right? And if the market has just changed trend, it's not the strongest downtrend that I can find. Okay? That means I'm not buying it anymore. Linear regression indicator. It plots the trend of the market's instrument's price. However, unlike a moving average, the linear regression indicator does not exhibit as much delay since it is fitting a line to data points rather than averaging them. And as they say, a picture is worth 1,000 words. So let's go to the chart. And, I started looking at this, and I thought, I have no idea what this is. It's the red line here, and you can see it. It's kind of jumping all over the place. And I thought, why would I even want to talk about that? It just looks like a short-term moving average. But in fact, it isn't. And so I thought, well, this is 14. I'm just going to put a 14-day simple moving average on there and compare. And all of a sudden, I started looking. I thought, for those of you who like to use crossovers, and I know there's quite a few here because you've talked to me about it, instead of using two different moving averages, maybe two different types of moving averages. And I thought, well, maybe a linear regression and a moving average, certainly the 1414 is just what I put on here, might be a better way to use, to use that style of trading rather than just using two of the same indicators. Use two different indicators. So linear regression might be good for that. As you can see here on crossovers, it does catch it, obviously in trending moves, but remember, we're cherry picking the trending markets to begin with. And, so we put ourselves in a position to be in some of those trending moves. So I decided that, well, I'm going to throw this one in because I know a lot of people love those crossovers because, number one, they're very easy to identify. It's pretty obvious when one line is crossing the other. And at this point in time, I'm only looking for the buys. So I'm only looking for the fast one, which is the linear regression, to move above the 14-day simple moving average. And we can see, there's a couple of nice trades on here, and a couple that look like they were break even. But it looked like there was something that worth some value there, particularly for people who use moving average crossovers, which I'm not a big fan of. But this one immediately looked better than that simple situation of looking of two moving averages. Okay, so I thought I'd throw this one in because I know it's a very popular style of trading. Okay, and on the downside, we can see the same thing. As a matter of fact, this is a stronger trending market. It actually looked pretty good. That if you were getting in on the crossover and then getting out when the market moved back above the line, getting in here, getting out there, getting in here, getting out there, getting in again, getting out. I mean, it looked like there was just a series of potentially profitable trades, and I thought, well, this is something I want to share. And but this is the linear regression. It is part of the market scope package, so you can put it right on there. Okay, so if you're using moving average crossovers and you're just getting whipsawed and the results aren't what you like, this might be something to look into, using the linear regression on that, because the crossovers looked like they offered a lot more value to a trader than just two simple moving averages, or a simple moving average and exponential moving average. Bollinger Band width. This is one we were talking about yesterday. In the basic, we talk about Bollinger Bands, and I thought the Bollinger Band width might offer some more value. On the charts that I have here, it doesn't, but believe me, this is something that's pretty good. I think that volatility is much more cyclical than the price itself, the price of the market itself. The volatility, is like a living, breathing thing. It inhales and it exhales. We go to markets where there's high volatility to markets where there's low volatility, and that's usually associated with some major news event. I'm guessing that right about today we're probably going to be moving into a low volatility area because this Friday is non-farm payroll day. And most of your big professional traders will not take on new positions the week of non-farm payroll. They would rather wait till after the fact and then decide what adjustments they have to make. So as the market gets closer to Friday, it's going to start trading in a range-bound situation. And some people are going to think they found the holy grail to trading. And then about 8:30 Eastern on Friday morning, everything's going to break loose and they're going to wonder what the heck hit them. They may be introduced to the Margin Watcher feature on the FXCM trading station. But this just basically measures the distance between the two bands, the two Bollinger Bands. Okay? As they come closer together, that means low volatility. As they expand apart, that means high volatility. And we're just showing it in the histogram. Okay? High volatility, low volatility. And you can see it can be kind of cyclical in nature. And if we probably would put an economic calendar on here, we could probably guess that some of those situations were when it broke out of a range. But I do know quite a few traders that love to use the Bollinger Band width in their trading because it will not tell you which direction the market is going to break out. But if you're trading in a strong trending market, you already have your directional bias. You just look for periods of low volatility and just look to buy the breakout in the direction of the trend. And obviously if it breaks out to the downside, you're not going to get into the trade because you had a buy stop. You're only going to get out above the breakout. Okay? But Bollinger Band width is a very valuable tool, and this is one where you go to FX code base and you can load that code down into the market scope charts. And on the downside, we see the same thing on my Euro Aussie. We can see that it's kind of breathing, inhaling, and exhaling. And if we would look at some of these lows, it's this situation here, where the market's about ready to break out into a strong trending move. Hopefully, a strong trending move. We don't know which way the breakout is going to be, but more often than not, which could mean 51%, it will break out in the direction of the trend. Sometimes, more often than not, is all a trader needs for an edge. Okay. Professional traders can take that 51% and make a living off it. There's another one that comes with Bollinger Band. It's the percent B. If you ever look at the Bollinger Bands and you see when the price channel touches the high band or moves through the low band, this is just an easy way to see that. Okay, it's just a better representation of when the markets touch the band, and it makes it a lot easier to see. And we can see here that if we were to put the Bollinger Bands up here, would be when the market touches the lower bands, which is an uptrend, is when we want to start looking for buying opportunity. Okay, because that represents a pullback down to support in an uptrend, right? So using the Bollinger Band percent B is just an easier way to tell when the market has moved through that band. Okay, obviously, again, we have an uptrend. We're only looking for buys, so we only want to look for the buy when the market touches the lower Bollinger Band. When the market touches the upper Bollinger Band, that usually means a breakout. You want to trade in the direction of the trend. But I like buying the pullbacks down to support. Okay, I want to catch as much of that trending move as I can. And again, on the flip side, we have two situations here, almost three, but I like to be accurate. We can see here it coincided nicely with two of the rallies up to resistance at the same time. Okay, and if we were to have the Bollinger Bands on here, these would be the 2 points where the market touched the upper band. This is just another way of looking at that. But actually, I kind of prefer this than the Bollinger Bands itself. I like to keep my charts clean. The rate of change. This one is really as old as the hills, and I've never really used it in my trading, but that's my personal preference. It has nothing to do with whether it's any good or not. But again, let's look at the. It really is an oscillator, which is telling us the same thing as say stochastics or RSI or kind of MACD, but not necessarily. But again, we're looking for the same thing, but it really doesn't quantify it for us. But rather, well, it's gotten low, okay, which is one of the reasons I don't like it. I would prefer like stochastics that quantifies or RSI that quantifies an oversold area as 20 in stochastics and maybe 30 in RSI. I would rather have it between 0 and 100 because then I can measure. It's easier to measure extremes, when you've got a scale of 0 to 100. This doesn't necessarily have the scale of 0 to 100. And but you can see how the rate of change it does identify some of the bottoms. But my preference is to use the actual oscillators with a scale because it's very easy to identify those bottoms when they're actually playing out. And particularly if you're using a moving average as a signal line to help you enter into the trade. And on the flip side, we can see it also identified nicely, and kind of that one, but it just didn't seem as extreme as those. But I think you can see, the downfall or the shortcoming of rate of change compared to some of the oscillators that we've been talking about. It just makes it easier to identify an extreme. How do you identify an extreme? How do you do that? After the fact, it's easy. Boy, yesterday was the hottest day of the month. And but we have some sort of a scale. It becomes easier to see. So as we know the temperature, it's easier to compare. Yes, sir. Yeah, well, it's really just the zero line, is the main line, and that's what a lot of people use. They use the cross over the zero line, but it didn't look that strong to me. Yeah, yeah. Oh, I just put the circles here because they represented extremes, but obviously that's after the fact when I can identify that. Which is what I was saying, if I'm using slow stochastics, I can identify it as it's happening because it's on a scale of 0 to 100. So it's easier to quantify an extreme when you've got a fixed scale. Okay, that was the difference on the, yeah. Parabolic SAR. It's a popular one, but I never really understood it. Okay, SAR means stop and reverse, which to me is breaking a rule of trading. I don't go from buys to sells because I'm only trading. And I have a directional bias in the direction of the trend. But some people really like to use this just for stops. But I got to tell you, every time I look at it, I mean, I just have to look away. I'm just not sure. Because, a lot of these candles have, dots on the top and the bottom. But I know they're popular, and I know a lot of people use them, and I don't want to just dismiss it, but I'm going to anyway, right? Yeah, I know. But I just think that there are so many more choices that make sense. But some people look at this and they will get it. Okay, and that's fine. And if you get it, and if you're looking at me like I'm some sort of idiot, I'm okay with that. If this makes sense to you, this is fantastic. The guy who developed it really knows what he's talking about and what he's doing. Okay, he developed a number of indicators. We covered about 3 of them yesterday in the basic indicators. And as a matter of fact, if anybody ever gets a chance to get this book, I don't have it on here. It's 1976. It's just Indicators for the Commodity Markets by J. Wells Wilder. It's really one of the classics on indicators. He talks about how he developed all his indicators. When they came home with that brand new Commodore 64 or whatever the heck they were buying back then and started poking in numbers, it would take them a week to code something, which now probably takes about 10 minutes. But they did it anyway. Boy, is that patience and discipline or what? And but he developed this at the same time. And a lot of people do like to use it for trailing their stops. And it can offer some value there. Obviously if you catch the trending moves here. But as much as I've tried to change it from a default setting to another one, I just seem to mess it up. So I've never really gotten that down. And believe me, I spent a lot of time trying. But I do know there are people out there that can use it quite effectively in their markets. But I would use it as a trailing stop. You can see how it kind of follows the market. And when it starts reverse, it will go through the dots. Yes, sir. Is it? I'll tell you in a second. All right, we're moving on then. All right. Remember I talked about yesterday, for those of you in the basic, on RSI, it's very easy to see, it's very easy to read, but my issue was that the setting that I like, the default setting of 14, really did not signal many trades at all. Okay? These guys, who are from Chicago, by the way, saw the same thing. And about 16 years ago, they wrote a book called The New Technical Trader, and they used part stochastics, part RSI to make RSI a more valuable indicator for the trader. And we showed yesterday on the RSI that it really didn't show any signals on either the Aussie-Swiss uptrend or the Euro-Aussie downtrend. And obviously they saw the same thing, but they were a little smarter than me. They just took it to another level and decided, well, actually what they saw is a way to develop a new indicator and put their name on it. So guys like me, 16 years later, would talk about these two gentlemen, and that's fine. And I just would move on to another indicator and find one that already worked. But that's just me. I was looking for instant gratification rather than, But if you look at this, I mean, this is very easy to see, and you can see every time it dips below 20, 80-20 are the extreme values here. And in this situation, you almost have to wait for it to move back above the 20 line after it's been below. But you can see it certainly gives you plenty of opportunities to get into trades, okay? Which automatically, to me, makes it much more valuable than just the RSI, okay? This is one that's not a default on the market scope charts, but you can download it at that site. Yes, sir. So, right here? Oh, right here? Yeah, it's 14, 14, 5, and 3, because you're doing it's a 14 RSI and a 14, 5, and 3 stochastics. I know, there's lots of numbers. And you can see on the downside, I mean, if you want to be a little bit more active on a daily chart, this might be the indicator for you. Being more active doesn't, it can lead to a lower winning percentage, but it certainly puts you in more trading opportunities. And you can see I would do the same thing. Instead of trying to when it changes direction, I would wait for it to actually close below the 80 line and then use that as my entry into the trade. But obviously, they got what they wanted out of this indicator, and that was kind of the juice up the RSI, so it offered a little bit more trading signals. And I do know people who use this and do like it. Fractal. Is this the last? Good. This is the last one because I want to talk about this one a second. What time is it? I've got time too. Fractal. Boy, when I first read fractal, I thought, I'm not into all that highfalutin math. I don't know that stuff. I don't understand it. It sounds like fractal chaos, butterfly theory. No, all I want to do is identify a trend and jump in. Fractal is really kind of a fancy word for a very simple thing. A basic fractal is when you've got one candle or one day's trading. The 2 days before it were lower, the lower highs. The 2 days after were lower highs. So you've basically got the V. The day in the middle is the fractal. I thought, well, this is probably the most simplest indicator, known to traders. And it is. Okay? So basically, a bearish fractal point is opposite. When you've got a low and the 2 days on each side of it had higher lows. Basically looking for the V bottom. That's all a fractal is. So I popped on the default setting of 5, which means the 2 candles on each side for a bearish fractal. Otherwise, the low have to be higher lows. And for the bullish, have to be lower highs, just the 2 days on each side. Okay? That's all a fractal is. I thought, well, that's easy. Let's pop it on there. I saw nothing but arrows. I go, wait a minute. That can't. That can't. There's got to be something. I'm missing something. So I said, well, I can change the values, and it said only odd numbers because obviously it's the middle days, the fractal, and the number of days. And I thought, well, let's pop it up. Let's turn it up a notch and let's make it 11. Now look at it. Now I can put this on the internet and say I've developed a strategy that is guaranteed to pick tops and bottoms, and I'm going to sell it to you for $999. And this is what it looked like on the Aussie Swiss. Can't you easily see that I'm catching the tops and the bottoms? But what's the key there? Yeah, I didn't know until 5 days after the fact. But I don't have to tell you that when I'm selling it to you. I'll release that information after your check is cleared. Okay? Which also gives me the opportunity. Be very, very careful when you see charts like this with those arrows and people are telling you they found the secret to trading and they're willing to share it with you for $1,000. Okay? If they're using fractals and they're using the value of 11, this is what the chart's going to look like. And I looked at it and I got excited for a second until I realized, well, wait a minute, I wouldn't know that until 5 days later. 5 days later, I'm already in the trade using just about any other indicator that I'm talking about. And I thought, well, let's go back to the 5 days because 2 days later doesn't sound bad. If I'm getting into a trade 2 candles after a high or a low, that's not too bad. Okay, well, there's got to be some value there. So I thought, well, I like that Arun thing. Let's match it up with Arun. So now I've got my extremes for Arun, and now I have my entry, which is 2 days after the lows. Okay? Now this is a good combination of using multiple indicators that are telling you different things. Okay? I can't sell it for $999 though, but yes, sir. No, this is the down line. You want to know when the down move has reached an extreme. Okay? Well, I'm only looking for buys because I'm in an uptrend. Okay, so I've got my directional bias. So all of these sells don't mean anything to me because I'm not going to sell an uptrend. Okay? Yeah, I'm looking for these extremes. Yeah, when the selling has hit an extreme. And I'm using the fractal, and I'm getting in 2 days after. And as you can see, I'm not missing a big portion of the move just using this simple strategy of combining the fractal and the Arun. And they're both available on the Markoscope charting package. Yes, sir. Well, I could sell this chart. I tell you, I could get a lot of people that want to believe that it's this easy. It is great. You can talk to me. I take Visa, MasterCard, not American Express, though. I would never do that. But you do see these kind of charts on the internet, and we used to get them in the mail, but they don't do mail anymore. Now they got the internet. So just a little bit of beware on that one, okay? I mean, I can generate it accidentally. All I have to do is take a snapshot of it and say, wouldn't you love to get in on these highs and lows? Well, who wouldn't? But they didn't tell you, well, I can't help you there, but this is a darn nice chart. Okay, and on the downside, it's just too many arrows. But I want to go back to my 4 steps. The first step is I open up a daily chart with 1 year of trading. Okay. The second step is I add a 200-day simple moving average because I want to look for the strongest trending markets that I can find. And then all I have to do is use my favorite technical indicator to help me time my entry in the direction of the trend. Now can I take some questions?